My name's Bob Harrison. I'm a consultant petroleum engineer. I've worked in the oil and gas industry since 1979. And I'm the managing director of a small consultancy, Soluzione Idrocarburi, which is registered in Italy. And we advise oil companies, new startups, on reserve audits, due diligence. We do asset screening for them, and basically try and help them make better deals and avoid the poorer deals. It's always easy to herald the success stories in the oil and gas business, but often things don't work out as planned. For example, when a deal's done, it may transpire that the buyer has paid way over the odds for his subsequently revised low reserves figure. And so in an effort to try and avoid this happening, the buyer will send his team to a data room and ask them to perform due diligence, which is usually pretty rigorous research to uncover and calculate any metrics that we use to input to the valuation model for the assets that are up for sale. Unfortunately, some buyers do forget the age-old warning of caveat emptor, and they try and take shortcuts in their valuation. And this is where these mistakes are often made. These could be a misjudged risk, exploration risk. They could overestimate the hydrocarbon volumes in place. Often well performances are overstated. We underestimate costs constantly, and there's as all deal makers that they're optimists, but this optimism may be misplaced, and if you make a mistake on these deals, they can be very expensive indeed. Well, the parties involved in any deal want to make sure that they make estimates of the hydrocarbon volumes in place, the reserves or the value, which they get from data to suit their needs. One party want to sell his assets, and you want to get the highest realistic price he can to satisfy his backers, because they want a return on their investment. The other party, he wants to buy the asset, he doesn't want to overpay. He'll struggle to deliver. If he does, he'll struggle to deliver the profits that his investors are anticipating. So getting to a mutually agreed price is tough enough, but matters get worse if the oil and gas price is on the rise. So the asset market is very buoyant, and the buyer comes under huge pressure from his investors to do a deal, or almost any deal. And this is where the shortcuts come in. So if the model is obtained using data from the data, it doesn't provide the valuation that is going to do the deal, it doesn't fit with the perception of the buyers and his backers. Often, an under pressure buyer can adjust the metrics that go into the model until he gets to the value he wants to do the deal. But this is dangerous. Well, it's with the desire to do a deal, if it starts obscuring let's say the technical and commercial reality, quite simply the companies are going to fail and the investors are going to lose their money. So if you try and do a deal based with models that are based on adjusted metrics to give the value you want, you're in the dangerous waters. Sellers are obviously going to inflate their estimates of the value of their perceived value of their assets, because they always believe, and quite rightly so, that buyers are going to come in and try and knock the seller's valuation down. But the buyer has to remain questioning. He has to be skeptical, and he's got to make sure that he doesn't let his desire or his investor's desire to do the deal obscure the facts that his own team's due diligence has come up with. If they do that, then they're going to do poor deals. Well, buyers have to try and remain impartial to any deal and let their auditing team, whichever they put together, strive to get the answers which are technically and economically justifiable. And there are crucial metrics which underpin any deal. Let's look at the well performance model. These are going to include initial production rate, well decline over time, the ultimate recovery from the well, plus we need to know an idea of how long it takes to drill the well and complete it, and how much this is going to cost. all these go into our model of the valuation of the asset. Now, we can get these metrics from drilling records, production data, which usually are on the asset up for sale, because these data are usually provided in the data room by the seller. That's if the asset's on stream. It gets a bit more complicated if the asset is an exploration license. They won't have any producing wells. In that case, we're going to have to look for analogues, and we have to create these analogues from regional data. In some cases, we're lucky because there are countries which publish these data, such as the USA, the UK, and so we can do our background research before entering, even going to the data room. Let's look at the USA and the UK, or the North Sea, for example. These are areas where oil field data are well documented and archived. They're published freely on the internet, and this really helps us, the professionals and the auditors, to perform good due diligence. And if we get good due diligence and don't take shortcuts, we're going to make less mistakes, and the deals are going to have a fairer price. They're going to go quicker, and you need less resources, and so everything is going to happen cheaper to do too. Unfortunately, for whatever the reason, there's still far too many, in my opinion, far too many countries and operators refuse to publish any data, let alone production data, which is crucial in asset evaluation. And in these countries, poorer deals are done, and they may not even get done at all if you can't agree on a fair value. And the problem is people are going in there, and it's basically becoming an act of faith. So if we can get access to actual data, we can match our evaluation models and try and make sure that they predict the true value of the asset as closely as possible. So, yeah, should we be happy? I don't think we should be happy, actually. I'll be happy when all the oil companies and governments around the world become more transparent and realise that it's in their interest too to release fully comprehensive oil and gas data sets, because they're going to allow the professionals like myself, investors and the researchers in academia to work on these assets and advance the industry.